US consumer prices unexpectedly fall in June. Welcome to Market Insight. I'm Elena Casas. The rate of consumer price growth fell 0.1% in June, taking year-on-year headline CPI down to 3%. In good news for the Fed, after Chair Jerome Powell stressed in his testimony to Congress this week that policymakers will need to see several months of good data before they can cut rates. He also said inflation is not the only risk, and waiting too long to cut could unduly weaken economic activity. The market interpreted that as a sign of a coming pivot and added to bets of a September rate cut, now standing at around 85%. Well, joining me now to talk about all that is Greg Daco, Chief Economist at EY Parthenon. Greg, hi. After a long wait then for inflation to come down in the US, why are we finally seeing it now?
I think we're seeing all of the right elements when it comes to the disinflationary momentum. We're seeing an environment where consumers are being a little bit more prudent with their purchases, in an environment where the labor market has gradually cooled, not retrenched, but gradually cooled. An environment also where there is more pricing sensitivity and therefore reduced pricing power. And an environment also, very importantly in the US, where rent disinflation is accelerating. All of those elements combined are pushing towards lower inflation as we move through the rest of the year. And we expect that momentum to continue into 2025 and bring inflation closer to the Fed's 2% target.
When we last spoke, you said the Fed should move to cut as soon as possible. You must now see the data pointing in the right direction. But could a September rate cut still be thrown off course?
Possibly. You never know what could happen in terms of the economic data. But yes, I think it would have been optimal to ease monetary policy in June or perhaps even in July. I think it's a little bit late now to have Fed policymakers signal a rate cut in the next couple of weeks. But we definitely think that a September rate cut is in the cards, and that there will be at least 2 rate cuts given economic developments, both on the inflation front, but importantly going forward on the labor market front, because that is an area where we're starting to see some signs of softening. And that's why Fed Chair Powell mentioned that inflation is no longer the only risk we face.
2 rate cuts, of course, still wasn't the forecast from the last dot plot we saw. Policymakers were only predicting 1. What are the key data points in the next couple of weeks, couple of months, that you think will direct them to make a decision one way or the other?
I think there are a couple of key reports that will be central for the Fed's decision process. The first one is, of course, the next payrolls report, where we'll see how the labor market is faring, not just in terms of job growth, but in terms of the direction of travel of the unemployment rate, which has been rising slowly, but creeping up above 4% over the course of the last few months. But also going forward, future readings on the pace of consumer spending and the pace of inflation, of course, in the coming months, to see whether there is that ongoing disinflationary momentum. There will be a bit of an uncomfortable plateau in terms of inflation over the summer. That's because year-over-year comparisons won't be as favorable as they have been. But if you look at the underlying drivers of disinflation, they're firmly in place, and we should see disinflation resume in the latter part of the year and favor further easing from the Fed.
On the labour market, Greg, it was interesting that Jerome Powell also said that it's back in balance and has essentially returned to pre-pandemic norms. Is that true, or are we going to see a substantially tighter labour market going forward simply because so many people left it during the pandemic?
We've had a significant rebound in labor supply. That's been one of the amazing feats of this recovery, in that we've seen the labor force participation rate rise quite steadily over the course of the past couple of years. In fact, if you look at the prime age labor force participation rate, which is the 25 to 55-year-olds, it's at a 15-year high, which is very strong, going back before the financial crisis. So we're in an environment where labor supply and labor demand are better balanced, but we are still in a relatively tight labor market where some sectors are still struggling to find the right type of labor. That is still putting some upward pressure on prices, on costs, and on wages, which is something that a lot of us are feeling when it comes to cost fatigue, and is one of the reasons why we're seeing more cautious spending, more cautious business investment. I think that's likely to stay with us for the coming months.
Jerome Powell also stressed, as you pointed out in your notes, the importance of Fed independence ahead of the election. Given the polls and the uncertainty around President Biden's health, is the Fed now having to consider how to approach a Trump presidency, which, of course, apart from everything else it might do, could be very inflationary?
I think the Fed remains very much apolitical, but there is certainly the optics of the upcoming elections that will play a role in how the Fed moves in terms of monetary policy. Again, the Fed policymakers are squarely focused on ensuring that their dual mandate is met: inflation back at 2% and maximum employment. That's what they want to achieve. Whether we get any significant changes in terms of policy is a big uncertainty at this juncture. So we'll have to see what types of policies are developed over the course of the next few years, and the Fed will react to those policies. If they're inflationary, it will tighten monetary policy. If they're disinflationary, the Fed will have more leeway to loosen monetary policy and ensure that the economy continues to go run apace, essentially at a maximum employment level.
Greg Daco of EY Parthenon, thank you so much for that analysis. Well, that's your market insight. You can watch more videos on Reuters.com.